The U.S. stock market is currently closed for the weekend. As of the final bell on Friday, November 7th, 2025, at 4 p.m. Eastern Time, shares of Nvidia, ticker symbol NVDA, closed the session at $188.15. This close represented a small gain of about 0.09% for the day, but that single number hides a wild, volatile session where the stock careened between a low of $178.91 and a high of $188.32, ultimately finishing near its peak. The expectation from a glance at that closing tick is one of stability, a flat day. But the reality is that the stock is currently in a brutal fight, having lost over 8% of its value in just the last week. This isn't the behavior of the unstoppable juggernaut everyone has been pricing in. There's a disconnect growing between the popular narrative and the tape, and it's centered on a word that makes boardrooms nervous: saturation. Not saturation of demand, but saturation of expectations. The market has priced in not just perfection, but a perfection that must accelerate indefinitely. We just saw what happens when that acceleration merely continues at a record-breaking pace instead of shattering its own records. The common belief is that Nvidia stock is a one-way ticket, the singular toll booth for the entire artificial intelligence build-out, with every major tech company, from Microsoft and Google to Meta and Amazon, committing to a combined $380 billion in AI-related capital expenditure this year. How could it lose? This spending is up 54% from last year, and Nvidia is the primary beneficiary. The company's data center revenue is, frankly, astounding. The most recent quarterly report for the second quarter of fiscal 2026 showed data center revenue hitting $41.1 billion. That's not a typo. $41.1 billion in 3 months, up 56% from the prior year. This is the expectation. Here is the reality. And it's what the stock's recent sharp drop is really about. The market is finally being forced to grapple with the single largest risk to this entire narrative: China. For the last 2 years, this was a manageable headwind. But the latest expansion of U.S. export restrictions has, by all accounts, effectively wiped out Nvidia's presence in the world's second-largest data center market. The new rules blocked sales of even the scaled-down B30A chips, and the impact is estimated to be a potential loss of anywhere from $2 billion to $5 billion in quarterly revenue. As if that wasn't enough, Beijing quickly followed up with a sweeping directive that all state-funded data centers must source only domestically designed chips. This isn't a temporary problem, it's a door slamming shut. This is the crack in the armor. It's the first time that Nvidia's growth has hit a wall that isn't a supply constraint, but a political one. And it's happening at the exact same time that the market's own expectations have become so inflated that even stellar results are met with a shrug. Look no further than the Q3 2025 earnings report. By any historical measure, it was a blowout. Revenue of $35 billion and 81 cents in EPS both beat estimates. But the stock fell 2% after the report. Why? Because management's Q4 guidance of $37.5 billion wasn't the $41 billion whisper number that the most bullish analysts had floated. This is the new, dangerous territory Nvidia stock finds itself in. It has to be perfect, and now a multi-billion-dollar chunk of its addressable market has been vaporized. This brings us to the recent trading action, which has been telling. That nearly 4% drop on Thursday, followed by Friday's massive 265 million share volume day, signals serious capital is moving. The average daily volume is already a high 180 million shares, but Friday's action was a clear event. This isn't just retail traders on a Robinhood app or SoFi Invest platform taking profits. This is institutional. This is the kind of volume you see when large Fidelity mutual funds or managers of Schwab Intelligent Portfolios are reevaluating their risk exposure. The stock is now trapped in a volatile channel, well off its 52-week high of $212. It's fighting to hold support around $178, and every rally is being met with selling pressure near $190. This price action is a direct reflection of that new, uncomfortable reality. The bull case is no longer simple. You can't just say AI and watch the stock go up. Now you have to factor in geopolitics, domestic competition from China's own chip makers, and the looming threat of margin compression as Nvidia is forced to fight for a smaller, albeit still large, piece of the global pie. Comment below with your thoughts on this. Do you believe the U.S. restrictions on China are a long-term disaster for Nvidia, or just a temporary hiccup? Of course, to understand the future, we have to respect the machine itself. What Nvidia has built is incredible. It's not just a chip company. The data center division, powered by the Hopper and new Blackwell architectures, is the undisputed king. But it's the CUDA software ecosystem that is the real moat. It's the deep, sticky platform that developers are trained on, that applications are built for, and that competitors like AMD, despite their strong MI300 chips, find so difficult to displace. This dominance makes self-investing in Nvidia stock seem like a sure bet compared to the complexities of Apple stock or Tesla stock, which face entirely different consumer and production headwinds. Nvidia's other segments are performing well too. The gaming division posted $4.3 billion in Q2, up 49% year-over-year, thanks to the new RTX 5060 Blackwell GPU. Professional visualization and automotive are adding another billion in combined quarterly revenue. The company is a diversified powerhouse. But when one division, the data center, accounts for nearly 90% of all revenue, it's not a diversified company. It's an AI company with hobbies. And that brings all the focus and all the risk right back to that one single narrative. So, where does that leave us? Looking forward, the upcoming Q3 2026 earnings report, expected around November 19th, is now one of the most critical in the company's history. Analysts are looking for revenue around $54.7 billion. The expectation is once again enormous. But the number everyone will be listening for is guidance and how management quantifies the true financial damage from the China ban. This will set the tone for 2026. The bull case rests on the idea that the CapEx boom from non-China customers will be so massive it doesn't matter. With hyperscalers building their own AI but still buying Nvidia's chips in bulk and the Blackwell and Rubin architectures on the horizon, demand looks secure. Analyst consensus remains a strong buy, with average price targets north of $230. Many investors using Fidelity, Interactive Brokers, or SoFi for their online investing see the recent 8% dip as a gift, a chance to buy the premier name in investment at a discount. The bear case, however, is no longer theoretical, it's here. First, there's the China problem, which is real and immediate. Second, there's competition, not just from AMD and Intel, but from Nvidia's own customers. Amazon, Google, and Meta are all pouring billions into developing their own custom AI accelerators to reduce their dependence on a single supplier. Third, there's valuation. With a market cap hovering around $4.6 trillion and a PE ratio in the mid-50s, the stock is priced for a future that is not just bright, but flawless. The slightest hint of slowing growth, whether from regulation, competition, or market saturation, could send shockwaves through the share price. We are watching a live test of the market's core belief. The expectation has been that Nvidia's technological lead is insurmountable. The reality is that a geopolitical pen stroke just proved that even an insurmountable lead can be fenced in. The story is no longer just about how many chips Nvidia can sell, it's about where it's allowed to sell them, and what happens when its biggest customers start to become its biggest competitors.